YouTube check 1 2. YouTube check. YouTube check 1 2. Okay, team. T minus 1 minute here. Okay, team, if I can have everybody let me know that you can hear my voice in the chat. Welcome back, everybody, and welcome back. We should be good to go. It looks like YouTube is officially live, and we also have the Discord side of things live as well. Let me see all of you. Good deal. What's up, matey? Good to see you, bro. Let me go ahead and make this a little bit larger so that I can see everybody speaking. Wrench, what's up? Good to see you there. Drew, good to see you there. Nice. T-Bone, what's up, buddy? Thank you guys for coming on out, right? Just gonna... Donzi, what's up? Good to see you there. But I'm gonna go ahead and put this out, team. Here, as a right, this is the last, actually the last lecture for Strategies 3. And we are reviewing some of the more critical topics regarding trading, right? And I thought it would be a cool thing to kind of share with you guys here, and because it's actually specific to the scalpers market that we're going to be starting here in shortly, right? In the next few days, a week about, and yeah. So if there are any questions, go ahead and show them up here, guys. I may not answer them as we go, but I will. As you know, I have the trading team or the master students on that Discord side, right? They're in the this is a remote location, right? It's a different Discord server than the ARCa Bulls trading team. But Lou, good to see you there. Loretta, happy New Year to you, and happy New Year to everybody. Thanks so much for coming on out, guys. So again, team, yep, this is just this is going to be a full-on lecture, right? It's apart from the entertainment side of the ARCa side, right? So I'm just gonna go ahead and dive in, introduce the class, and get this thing officially rolling and rolling. If you don't mind, guys, please make sure to hit that like button and subscribe to the channel, as it does help with the algorithm in favoring us to display us to like-minded traders. But yeah, oh, nice, Drew, you hear me? Good stuff. Mike, good to go is right. Actually, to you know what? We could liven it up a little, or kind of make it not so strict, right? I agree, and this is something I typically do when it comes to more serious conversations in a live setting where there could be many people. I would put just a slight bit of white noise in the back, right? But yes, team, welcome back, everybody. Let's go ahead and just get this thing rolling here. So this is, let's see, I want to make sure that you know that this is the last lecture, guys. So if there's a lot of gaps in this, you'll know pretty much why. But welcome back, master students. This is Strategies 3, week number 15-1. We're going to do volatility scalps and review, actually, the review 2 of the volatility scalps. And I'd like for you to remember that this is your last your last review before we actually go into your finals examination. So please remember to review these videos, right? I know that we're not going to have everybody in here, and that's and that's okay, right? This is why the lectures are all filmed, and this is why you can refer back to them and study them further, right, guys? So without any further ado, let's go ahead and jump into things here. So now I'm going to go ahead and speak. Remember, guys, that we've based a lot of this Strategies 3. We've used plenty of crypto, right? And that's a typical thing. And we've seen some succession here using crypto analysis versus equity analysis and everything else, right, guys? That's because we are essentially using the psychology, right? And not so much the ideology, right? So we know that we can rely on behavior based on macro events, based on catalysts, based on behaviors that can repeat on a daily basis, or that can introduce some type of, I'd say, this is where the statistical side of things come in, right? What's the behavior like on a Monday versus a Friday at 3 p.m. of the third week of the month of which month, right? So we have plenty of that to go. Now, does it pertain to volatility scalps? Maybe sometimes, right? But a macro look like that really doesn't have too much to do with that immediate short term. Now, speaking of volatility scalps, this means that you would be able to gain knowledge over how an asset can behave based on the events of an overnight catalyst. Let's go ahead and take into consideration here some equities, right? So let's go ahead and pull up. I don't know. Let's do something simple, right? Like the SPY, right, guys? Let's pull up the SPY and see on a daily time frame what can happen. You know, for example, like this, right? You have the traded day. Remember, your green candles open at the bottom, right? They close at the top. The wick is your history, right? So let's go. Hold on, guys. Let me just go ahead and okay. You all are seeing the ticker SPY, correct? I want to make sure that you are observing this. I'm streaming to 2 different places, and I want to make sure that you guys can actually see the actual ticker that I have. So it's ticker SPY. You guys see it, right? Good. All right, good deal. Okay, so let's take into consideration something like this. So the typical behavior of this asset gapping up into the next day has a specific behavior day to day, right? Let's just say the iteration itself means that it closed at this 671.74 and it opened the next bar at around 0.70. Jay, thank you so much, brother. So it moved about 0.70% up on the next day. So this is equivalent to around a $5 jump. So at what point, at what dollar value or what percentage would it take for this to open up and maybe consider a drop back all the way down to validate its support, which is the prior day's high? And also, does it have that property at all? Because it looks like on this iteration here, this day, remember, these are daily candles, right? It's a whole day of trading. They open, they range, right? They close, and that's it. And then your next day happens. So we have a second iteration here that didn't actually pull back, and it is less than the one that we're on right now. So if we can just measure that distance, this one's already measuring 0.43% rather than the 0.70. Okay. And we also have another one up here that didn't retrace towards its day. What's that one measure? So we can see here that that's 0.82 and it still didn't retrace. But what about that last one? This one here. So that did open, right? It gapped up and it opened and it retraced to close the gap of the day before it continued. So that's the kind of behavior that I'm talking about. If we can find what that average is, right? If we can find at what point would it consider to retrace back to its day? So this here is a 0.27. So the smallest one we noticed here was just about a 0.43. Right at this difference here. Okay. So if it is within that range, there's another one right over here, right? We can take into consideration measuring that as well. Check it out. Oh, actually it opened up right here. Look at that. So this one is 0.38. So it's under that 0.43. Okay, so we can now assume, now we have, guys, I would expect for you to really go back in time, right? And quantify this, right? Look how many times does it or doesn't. Because this is another iteration right down here, right? And you can see that the close to the opening of the bar, which let's go ahead and grab that tool, just like this here. You can see that that's 0.22% and it retraced towards the prior day's close or opening valuation, right? It closed the gap and then it continued. So did this one here. Is it bigger or is it above your percentage base that you're looking for? It's 0.28. So that one did too. So now you see what I mean? So it looks like things that are right around the 0.40 or 0.43 and up appear to have this reaction where it doesn't retrace. So if we can already determine that, statistically speaking, day to day, by testing it back and back and back and back, as many iterations as we can to get a viable idea, an educated idea, then that can introduce us into a new potential for a volatility movement that can be incredibly profitable for that immediate short term. And I'm really talking about moves that can happen within the first 5, 10, 15, 20 to 30 minutes, maybe even an hourly at tops, to benefit from immediate short-term moves. And that's hence the term volatility scalp. Those types of moves are very much something that are taken into consideration on a daily basis by many traders. And this is why, at least in the equity side of things, you have that initial pump. The first guys, there's a reason why there's a strategy called a 15-minute opening range breakout, 15-minute opening range breakdown, right? You have a 30-minute opening range and an hourly opening range breakout. That's because the first hour of the day is the most volatile hour alongside the last hour of the traded day. Knowing these little tiny bits of statistics will benefit you. In the crypto side of things, there is a daily open, there is a daily close, but as you can see, it's 24 hours throughout the day. So maybe the volatility isn't presented the way that it is in equities. The volatility presented for opportunities like these have a lot to do with market open and close depending on your world, right? So having the Chinese market or the Asian markets open, having the London session open or close, which one of those markets introduced to you the bigger volatility for that specific range? Is it 15 minutes? Is it 30? Is it an hour? And that's what I mean, is knowing the little tiny bits of information like that will greatly assist you in trying to pull from an immediate short term. Now, as a lot of people ask me too, well, I'm not really interested too much. I've always wanted to day trade, right? But I'm holding, like, for example, I'm holding XRP for the long term. I'm holding it forever, right? So why would this, whatever? Why would this matter to me? Well, a lot of people already kind of know that I present opportunities from the ticker that you are observing or trading to generate more income, to pick up more of the asset that you're holding long term. What I mean by that is that should you have tapped out on your cash and you can't really go in anymore, right? because you would have to save a lot more money and generate a lot more cash to go in on the ticker that you want. Why not use a bit of cash, of that cash, to generate more of the asset that you want? So that would be something that the gamblers would call house money. And that's the idea that I've always presented. And that's why a lot of people ask me, well, come back when it moves like this much, or why are you talking about this? Or why are you talking about that? Well, understanding the day-to-day moves is also pretty nice to know, right? Because you want to know if it's going to rain tomorrow. You want to know if it's going to be rain or shine, right? So think of it as a forecast system. And then if you can benefit from your own forecast system, then you can actually put it to practice to return some cash or return some more of your XRP that you potentially lost, right? So there are many ways, many ways to observe or practice what I'm talking to you about here. And I think that could be a viable solution there, right? So next, let's go ahead and speak of that exact situation that we just talked about. So we notice right away that our threshold would be 0.30% gap up as a ratio to determine that it would retrace back to the opening of the day, right? So what we would do in that case, that it's if we're opening the range right here, right, the gap up on the overnight session. If we open up that next traded day anywhere above 0.30%, we can already determine that we may not even get any type of pullback before continuing to the upside, as it has done, several times here. So in that case, some people try to gain access into a position using some options contracts or something at the open of the day in hopes of getting a massive move to the upside based on the probabilities that it won't retrace based on the data that you have already collected and quantified and put down all by yourself. So I'm talking about the SPY here though, right? I'm talking about the SPY. This may not be the same for the QQQ. It may not be the same for anything else. It may be particular to this. Now, if that is the kind of power that you can grab, this is the kind of power that you can attain here in understanding probabilities, just based on literally just the gap up of the day. Then how much more can you calculate or quantify based on just this is just the opening of the day. So and this is also a Monday here, so which would be this would be the second week or the second week of the Monday of the start of the third week of October. So if that shows you that it did have an upside, and then the other Octobers also show you that they had upside, regardless of a gap up or gap down. So then your probabilities are landing even further and further towards viable for a continuation to the upside. So what I'm saying here is that maybe, considering one ticker, yeah, you could grab all the information that you can to determine moves during the whole day. Maybe you can acquire data like that to determine the probabilities and definitely bank off of them from one ticker. But there are going to be times to this where the one ticker that you're observing may be a bit on the side of illiquid. So there's really no, there's nothing happening there, which would introduce you into more of a macro analysis. So if you can look into a macro analysis, then that would actually put you on the weekly time frame. So what weeks of the year or what weeks of the month are the most likely to have volatility, which would introduce then your individual day's behavior. And this is all in the name of just picking up from the immediate short term. If you're able to quantify how this behaves on the second week or the opening of the third week of October, typically back in history, and you start to notice those patterns, you start to notice those occurrences, the iterations. In this case, they would be samples, statistically speaking. So if you can gather those samples and absolutely find a behavior to the tune of 70 to 80% probability basis, now we're talking, right? And then furthermore, imagine you were able to understand which month, right? And which week of the month, which day of the week of the month, which hour set of the week of the month of the day. Imagine the power that you can gain over understanding how your asset can move. Now, this would be, yeah, and like I said, right, it's in the name of understanding how the asset can move, sure, and pick up some extra cash here and there from the immediate short term, all good, right? But what is that going to do for your knowledge overall in understanding the cyclical part of the entire year for the asset that you love? So then you're going to know the down months. You're going to know the blocks of illiquid behavior. You're going to know when to expect not much movement because we behave. Should it be that there's an outside source to pressure price action towards the upside or towards the downside? Sure. Lou is saying it would give a hell of a lot of confidence. I agree. Because we behave a certain way, guys. The moment that we can understand that, yeah, sure, of course, the institutions and the big money, the whales and all that good stuff, right? They manipulate price. But why though? Why and how? If we can track how they manipulate price, you think you find a pattern there? Because I'll tell you this in one shot. an institution or a whale or whales in cahoots with each other, they wouldn't have a market to manipulate if it weren't for you there. So that means that you need to be standing in a sort of position. You need to be like that, sitting ducks, like how they say. You need to be that typical amount of sitting ducks in a certain area where they feel comfortable to practice. But if you're not there, then there's nothing to practice. But if you're there in that position over and over and over in a cyclical manner, repetitive iterations and continuing iterations, then there's a reason to do it. So imagine having you backtest the times where you believe that there was true market manipulation. You can track those and date them, right? You'll put a tag on them and find out. That's the greatest thing that is available to us. It's the fact that all you have to do is look. And the chart is right there, right in front of us. And we can expand the chart, and we can even contract the chart. We can observe it from like this daily time frame, right? There's a whole bunch of days here. We can observe it from maybe the perspective of monthly charts. There's a whole bunch of months here. What about observing it from 1 minute, tiny intervals at a time, for weeks and or months and or days at a time? The valleys that you see, right? The capitulation times that you see, the rise can finally introduce to you something very clear to a day trader. The fact that we move up or that we move down is simply moments of greed and moments of fear. So if there are emotions introduced to this, and we are told not to trade with emotions, then I probably would defy that information, because it's the very emotion that we can read, just like the institutions benefit off understanding your own psychology and working it against you. So why would we do that? Why would we press ourselves against emotion? Why don't we understand it, track it, put it together, observe it, and execute it? Because that, my friends, is what I do. I tend to observe this, guys. I promise you this. From October 10th to around, I would say, the mid part of December, the markets were completely different. The strategies that I usually did were completely off. The rate of loss increased, but in that rate of loss increasing, you're also understanding and you're gathering data because of that black swan that happened. So as we gather data and we understand it, we then see how a market can rebalance. And that's just like Joe is saying, and that's the game, right? There's always going to be a wrench thrown into this thing to kind of wiggle everything around, and then somebody's going to come out and, work on that, fix it, let it come back to its typical whatever it is. Great. So then our practice becomes and continues. So if we are able to understand, again, the valleys of price, the trajectory of price, as this being a very likely fearful moment, as this being a moment of opportunity, because that's where we fail as intraday traders. For understanding, Lou, yes. What we're not understanding, guys, is that the market doesn't forever drop. The market has this behavior. Let's choose this real quick. Let's go to the SPX and look at this from a weekly time frame. Let's zoom out like crazy. Make sure that we observe this in a logarithmic chart and take a look at its, you know what? Looks like we're going to have to go to maybe even a quarterly chart. There we go. That's a lot better. Zooming so we could see the entire history of the S&P 500, the Standard & Poor's index. From when? 1871, all the way to present day. Technically speaking, the S&P 500 has been on an uprise since the beginning of time. So the valleys that you're looking at, like these here, right? Like this one here. You see corrections like this, corrections like those. You see the October. You see the what is it? What is February, April? No, April, May. I think it was May or June or whatever of 2025. You see that correction there. Observing this in a macro space will allow you to understand that the markets are just moving upward, that we're just rebalancing, we're repositioning. So guys, if there is room to understand anything, understand that behavior is us. We are the reason that we are the reason that anything is put together in the chart. Anything is displayed to you here is because of us, retail. They tell you all the time. The institutions play with your psychology. They know when you're going to buy. They know when you're going to sell. So if that is the case and the institution also practices charting like this, then why not understand it a bit more, right? Why not understand that this has a cyclical behavior? Like, for example, this many of the 6-month bearish engulfing candle iterations have introduced downside. And that means when the red bar is a lot bigger than your prior green bar. This is 2021 for a low, right? We have a bearish engulfing right over here. 6-month iteration. This is July 2015 for a downside, right? So we have iterations like this where we can study. Right? We can see that we have another bearish engulfing, but it didn't print and it didn't give us that much downside on this one, did it? So as we continue to observe and as we continue to study, we notice back in time that, wow, there's another bearish engulfing and we definitely got a downside there, and that was the crash of 77. Here's another bearish engulfing and the crash of 73. Here's another bearish engulfing and the crash of 69. Another bearish engulfing, not so much downside, but it certainly was there, of 62. Right? And we continue. Here's another one, 1946, bearish engulfing print. Here's another one, bearish engulfing print, 1938. Another one right here, 1940. And guess which one this is here? That's the famous 6-month bearish engulfing, 1929. So if we understand behavior, if we understand that there is a typical or a usually or a probability says, then we would be ahead of the norm. Then we would also introduce the potentials of maybe this is the top of the market. We're looking like we're printing a bearish engulfing here. We're about to eat all kinds of crap. It's looking like another one's printing here, guys. 1972, 1973, we're about to eat it. And then it happens. Because most of the time, these bearish engulfings have materialized. So again, behavior. Now, what I'm showing you is a macro behavior. What I showed you prior to this on the SPY, and believe me, guys, this is part of Ethereum, it's part of Bitcoin, it's part of everything. So under the immediate short term, we were looking at a daily time frame, and we were just observing how many times the asset can actually retrace to the closing of the prior day before continuing to the upside. What's the typical behavior there? You see how it all boils down to something small like this? The whole act here is just to understand that there is a probability of it. It's not to predict. It's not for you to say that this is or isn't going to happen, like Guardian is saying. If you're seeing it in the chart, chances are that others are too. 100%. Right? Keep in mind, team, that the strategies that are presented, the strategies that we can look over, the strategies that we can even come up with, they are never going to be 100%. They're never going to be 100% printed or solidified or generated as the winning indicator or the winning strategy that's going to get you from $0 to $1 million in overnight. There's no such thing. Hard work is here, team. Understanding this, because really understanding it is another thing. The cool little gimmick that I put here for my students, that, somebody asked me early, What separates you from anyone else teaching this, like any other influencer? And I thought about it for a good few days, maybe even weeks. So I decided to change the way I did things. I decided to put in a gimmick in there. I decided to not teach so much in the hindsight. So what I did was the lecture I would teach you based on whatever's presently there, based on the hierarchy of the 17, 18, 19 weeks of whatever we're observing here in the segment, third segment of 5 or whatever. I would decide to look not in the hindsight. I would teach you based on hindsight, but then end the lecture with introducing to you what's going to happen with probability basis. So I would present to you not only the entries, but I would also present to you the exits and potential tops of the market within the time frame that we're observing the lecture. So I would say, I'm going to go ahead and just put in the alerts here, and I'll let you know when it reaches. It should be, and I would say it should be within the next 2 days, should be within the next day, should be within the week. Sometimes within the week would happen in the next day or the next 2 hours for some reason, but still it happened. So that's the gimmick that I introduced. I introduced teaching it, not in the hindsight. I introduced teaching it by putting my money where my mouth is and telling you that based on what I'm teaching you here, this should happen. I want it to be a little different than anyone else. And now, going into this type of lecture, going into the lecture of volatility scalps, that is, you're talking about giving the future into the next 5 minutes or 10 minutes or whatever. And I don't know if you guys have noticed this, but I do that all the time in the videos that I put together for XRP. I would say, I'm going to put the alert here because price action should reach here within the time or by the time that we finish this video. I do that so that you can see and you can understand and feel calm that there is typical price action happening. So if you can see that we are positioned here and we're saying that price is likely to go to this place here, and then in that same video, I'm telling you, okay, so if this happens, criteria, right? If this happens, that happens, this happens, then we have the gates opened for a potential this happening in the larger time frame. So you'll know the values, the ups and downs, the risks and the potentials, and the probability basis of that higher target happening. So that's kind of what I want you guys to observe things like, okay? So now that we know, right? Now that we know that in a volatility scalp, anything above not point, we said around 3.8% gap up usually means probably no retrace, but continuation to the upside. And continue to the upside, how much? And how much do we want to know, right? Because if we position ourselves 667.33 and go down to like a 5-minute time frame. Wait. I'm going to have to position this here too because we're not going to know where we are. And go on a 5-minute time frame and just kind of look for where we are. There it is. Okay. This was the close of your prior day, right? And this is the open of your next day. So how far up can we go towards the closing of the market the next day, right? So that we're going to go ahead and position this as 5-minute candles to last all the way to 1 p.m. Pacific time, guys. That would be my close of the market, right? It would be just about this point here. Okay. So if your phase is lasting from 12:55 p.m. prior day, 12:55 p.m. the following day, that gives you this entire time here to determine the probabilities historically speaking. So the top of the market isn't actually right at the open. The top of the market didn't happen until just about an hour and 50 minutes prior to the closing of the day. So if it is 2 hours prior to the closing of the day, this introduces you to something else. That means that either you have a time frame closing there that you don't know of just yet, or you have, say, for example, your weekly, like what's happening now. We're on the 3rd of January right now, right? sorry, argue. What the hell? We're on the 4th, right? In the 4th. So tomorrow in equities, we're going to be closing the one. I think I just said it on the video here too for XRP, for crypto. We're closing a 1 day, 2 day, 4 day. I believe we're closing a weekly, bi-weekly, 3 week, 4 week, and 5 week candle too. It's some crazy thing like that. And we're closing it on the 5th, like 5 days, 4 or 5 days into the new year. So in this area here, could there be a reason for you to pull back? Absolutely. You would have to take a look at your 2 day time frame, because 2 day time frames, if they're closing there, that means that you have about 2 hours prior to the closing of a 2 day bar to decompress. So could that be the reason? I don't know. We have to take a look at it while we're going. But that's still not what we want to know. We want to know how much upside we can face on average, whatever time frame or exposure you want to observe. It doesn't matter how high it went on the day. It doesn't matter how low it went on a day. You want to know how high typically within what. If you want to trade the first hour, then you then you analyze the first hour. So what, or the first 2 hours. So you analyze based on that gap up, that's certainly more than 0.38% or 0.4% more, the one that presents to you no retrace, and you study the probabilities, you study the range to the upside within the first 2 hours of the day. And when you practice that, when you know that data, and I'm talking about again, I'm talking about really studying it over and over and over. Catch the pattern. Catch the pattern. Know on average how much it can do. The thing is that when this thing tells you, you can actually move about, let's say, 0.12% up within the first 2 hours of the trade. So that would put you at just about right here. The 8:30 mark would be right here, right? 8, 9, 10, 11, it would be 11:30 a.m. Eastern, 8:30 a.m. Pacific. So this tells you that within the first 2 hours of the day, it'll probably tell you something like this. The data is going to tell you you can move roughly about 0.49% to the upside, roughly. So when you see that, you're not thinking to yourself, the statistical target is the target that you want to observe here. No. If it's telling you that, go ahead and take exactly that measurement, right? Create a horizontal array there or something, right? Let's just go ahead and make sure that it is completely different than any other one, because this is the target that you're expected to reach, right? So let's just say that that's going to be a neon green, super duper thick array. Okay. So this is the statistical top side based on whatever happens here on a 0.40 gapped up day. So you look historically and you start to determine, okay, well, yeah, it looks like 0.40 is a great area for us to pull out some profits. There's a lot of resistance at this point. So then you're thinking to yourself, okay, let me actually adjust my target down to that point. So you're thinking now, okay, great. So this means that we could open up the market at 667 and move up literally $3, right? $3 up. Guys, when you're playing options contract, that's a huge, huge difference. Now, you do have proximity though, because there is a gap over here. Look at that gap right in there, right in here. So you're thinking to yourself, oh my goodness, there's a gap in there that we could take advantage of, right? So why don't we do this? Let's position our take profit there just per se and look in the larger time frame to see if there's anything in there that we could benefit from, like during a weekly time frame. Could there be a bigger pivot that we might as well would reach? So let's think. Okay, so now we're observing the top line being 671.30, right? Cool. So let's just look 671.30. Remember, your price is over here on the right as we scroll, right? 671.30. Wait. We have this. Hold on. We have this here. The top of this candle, the opening of this red candle, confluent to this candle over here closing. So I'm looking now closer to 672 target, right? So why don't we just do that? let's go ahead and just might as well ourselves into that 670, what is it? 671.97, right? We'll put a line right there since it is relatively close to the time frame that we're observing. So now we can go back to that 5-minute time frame and see how that does according to the data that we have for an available trade. Okay, so let's go back. Let's find our position again and see what the heck is happening here, right? So here we are. This is our day here, right, that we're trading, and we have put the levels, statistically speaking, right, and the levels that we think we could reach within the 2-hour period, which we identified to be right here. The 8:30 mark was right about this point here, right? Let's get rid of that. Bam. We get rid of that. 8:30 appears to be right at this point here, right? But we used discretion and we said that this could be it, right? And we topped out our targets, adjusting so that it can be this top here. Discretion led us to this. And then we discovered that we had further upside targets into this area here, which introduces another level of potential should we reach it. That means that we would actually have to play 2 games here. So if you reach your statistical target and you're noticing that your original statistical target was around this middle part, so we said might as well up here, and then we could adjust a little bit lower because of this pivot. That makes this pivot a great support. So that means that you're trading at the open here. You're going all the way up to that $3, $3+ right? You can remove percentages here by, say, around 35% your position, validate the support of that major trough, find the volume for increasing upside, right? As soon as you start to find that volume, you can break your local support resistance, that is, which is an area that typically tends to rhyme with each other. All these bars are all at the same place. Look, including these two, including this 1, 2, 3, 4, 5, all of those are relative to each other, this entire area. That means it's a zone of interest. You break that, right? You go to the upside, you break it. Here's your back test, and even your back test to even lower, right? And then you continue. So your validations would play. You get long again, that 35% that you took, let it rip. And you take it to the next target where you believe there could be the resistance. Now, was it the top of the market? No, it wasn't the top of the market, because the top of the market was up here at 670, freaking almost 3. But what did you do? You took position at the open of the market at around 667, and you played for this to go all the way to just about 672. So that marks off an almost $5 volatility scalp with take profits of 35% in here, re-enter at the break of structure, and continue to the might as well target that you identified with discretion. Guys, if you played a next day options contract on the SPY, something like, for example, if you said 667, you're playing almost at the money. You're saying that I want to go ahead and bet on the 670s. Strikes, next day, expiry, right? This play, holding all the way over here, that, guys, that might be a 200% gainer, 300% gainer. I'm talking about making $300 out of $100. You know what I mean? Or making 3 G's out of 1 G. You think about it. And it lasted for just a couple hours of the day. So this is just highlighting a very, very, very simple strategy that we're going to be looking at in the Scalpers Market Mentorship coming up. And there are 14 weeks of it. And I just highlighted something that's, I guess we can consider this what? Rudimentary, I guess, fundamental. This is a very typical strategy, guys. This is something that happens. It just happens. You know, is it effective? Sure. Could there be something else that maybe aligns more with the type of trader that you are? Absolutely. 100%. Could there be something that maybe makes you more comfortable but doesn't align more of who you are as a trader? Have you ever found that balance? Well, that's what I'm willing to exploit. I want to see if we can find that. I want to see if we could discover that. But we won't do it by observing the past. We would do it by understanding the past and putting our ideas and our strategies and our execution furthermore into the future for a better and better and better looking portfolio. Now, team, that is pretty much it for the lecture today. I'd like to actually just get questions now. If you are interested, guys, just look in the description below. 2 algorithms, 2 mentorships, you choose them. The beginners and scalpers. You want the beginners and strategies because strategies is 19 weeks long. Beginners is 9 weeks. If you, whatever you want. If you already know the beginners, you can do strategies and executions. Then there's like 40 weeks in there. Right? So you choose, guys. This is the Snowflake blowout. It's not going to be that price again. So make sure to take advantage of it as I am closing that opportunity, guys. In this, I think it was either, I got to look at the calendar, but I think it's either tonight or the next day. So make sure to take advantage of that right away, team. But yeah, all that in the money, man. Imagine. Loretta saying, wow, I got it. I love it so much. That's awesome, guys. Guardian, thank you for that, buddy. Really appreciate you, team. I'm really looking forward to the scalpers class. I love it. I love it, Lioness. We're going to kill it. We are absolutely going to kill it, guys. So remember, team, we're looking to start here literally within a week. We're going to have max. Now that we're getting all of these students back from their vacations and stuff, then we're looking A-OK. Oof. That looks like a breakout ready, man. And this guys, look at this, man. This is one of my students here, guys. He's been tracking the breakout from XRP for a while now. And this was his trajectory laid out way before any of this happened. Let's go, brother. I love it so much, man. So yeah, guys, any questions you have, throw them at me, right? But the next time, do you find it easier to do longer time, like 2 to 4 hours? No, I don't find it easier or harder. It just is grainier, so the shorter the time frame, the more grain you introduce into your analysis, the bigger the probability of failure you wouldn't be introduced to, correct? So the larger the time frame, the lesser the failing iterations would be. So behavior starts to really choose a side as you increase time frames. As you decrease time frame and you just increase iteration here, right? So it just happen every other 5 minutes. That just becomes grain. So data becomes like a 50-50. But as you increase time frame, you'll notice that your data starts to favor a side or another. And that's really where the magic starts to happen. So you would actually have to observe your higher time frame and then work backwards to see how the probabilities of this not going down this time because of this, higher probability basis of continued upside on a 2 hour or 4 hour. How does that play into the hourly time frame of your scalp or something short term? That's where you become, you. That's where things would start to I guess the creativity of the individual character or trader, that would be where you start to shine. How clever are you to go and get that money? How willing are you opposing anybody else to go and get that money? That's the whole thing. And it's sad, really, right? Because it is a zero-sum game. Someone is going to get zero. Someone's going to get some, But you want to make sure that you're always in the winning side of things, right? You have to be, I guess, creative. The imagination, right? The ability to look at this as trust me when I say I know lots of institutional traders personally that really just look at this like a video game, right? And I tend to look at it like chess because it is a strategy versus another strategy. So how do you position yourself against somebody else's strategy like that? Well, that's your pocket of opportunity. Lil Nicky saying, for these volatility scalps, are you putting any consideration on fundamental analysis, or this is strictly technical, statistical, mathematical game? Depending on time. The initial answer is no. I'm not putting any consideration of fundamental analysis within that. But should you consider time in one of the three areas of higher probability breakout zones, which typically tends to be the beginning, first hour of the day, the last hour of the day in the equity side, and potentially during or after the lunch hour. So if we're talking about lunch hour risk, then yes, we have to put consideration to some fundamental catalyst. Why? Because that's typically when news gets released. So the strategy that we use in the middle of the day is not quite the strategy that we use for the last part of the day or the first part of the day. And it's, again, right, thinking about thinking about the tiny little rules that apply to the overall. Guys, the more rules you know to the game, the better you are, right? The better you'll be. That's the whole thing here. And it doesn't, you know, that you'll come across some dude who's mega nerd and it works very well, whatever, right? But you'll also see that it's just because you're catching patterns, like, oh, you know what, around this time this happens. It's because you're so used to seeing it. You're so used to observing it that these behaviors just bleed and happen all the time. And you're thinking to yourself, this happens all the time. You know, while that's not a sound way to observe or practice statistics or or probabilities, it is a pattern recognition type of strategy, which I know many traders who've done really good based on pattern recognition. And is it wrong or is it right? It's not for me to say. If it's right for them, then great. If it's not, then, you know, let's look for something else. I'm not here to invalidate or validate any other strategy. In fact, I'm going to show you and exploit to you so many different strategies that I personally don't even agree with. For example, using Mercury's retrograde, using the solar system cycles, moon cycles. What do you want? You know, let's go. We'll go ahead and present it. Should it show high probability return, then maybe it's worth a shot. Maybe it's worth looking at. And maybe, just maybe, it'll introduce to you a strategy that you never knew before and one that can make you a better trader. And overall, even if you are an investor that's holding for the long term, maybe, and just maybe, you'll understand that observing a 1-minute candle structure throughout the span of maybe 4 hours, it might actually rhyme with observing a 1-month candle throughout the span of 4 years. Doesn't that really tickle a probability? That's because the chances of it happening like that are probably true. Given that the 1 minute has a lot of grain, sure. But candle structures and candle behavior, they tend to rhyme all the way through the spectrum of time. And that's what I want to teach you guys. So make sure, guys, sign up, do your thing, come back. Let's continue the journey into becoming better traders. Guardian saying, I'm glad you gave the example of which contract you'd go for. Good to have some room for in the money when possible, right? Yeah, I actually think that the contracts that usually at the monies are pretty good. Little Nicky, I hope I did understand. I hope I did understand your question and answered it correctly. But if I didn't, my good sir, then please reiterate it. And, good notes for the old notebook. All right, I love it. Okay, team. So I want you guys to put any questions, right? Any at all. So old man is saying, I'm wondering how much different executions will be from the scalpers class. Very. Incredibly different. Not the same whatsoever. The scalpers market is, man, that's you'll lightly see that is more balls to the wall. It's the scalpers market is a mentorship program, ideally, to observing the potential of a chance coming up and taking that chance. That's the whole thing of that, you know. That's where a lot of day traders fail, at the chance of it. learn to let go of the break, you know? Learn something new every time. Great class. Thanks, bro. Bulldozer, love you, buddy. But yeah, so the executions class has a lot to do with your personal psychology and understanding the psychology of the market itself and what you do against that opportunity. Managing those losses. Yeah, bro. Damn. When does it start? I'm looking to start all these new classes, guys, within the next week and a half, right around there. We are just at about there, and I think I'm going to go ahead and cut the enrollment so we can start getting this completely organized. I think I don't know if it was tonight or tomorrow morning. I got to look at the calendar. I still have to take a look at it. We'll take a closer look at the SPY at market prep tonight for sure, and then you can compare with me too. I have to. Sure, I have to look too. Old man, if you are talking about the Alpha Lite and all that stuff, it is already granted to you, buddy. I replied by email. Let's see, ARCa brother, is the class during live trading? That will be only something that I put together for the fourth or for the fifth and last segment students. That would be conditioning. So going through the beginners, going through strategies, going through executions, and actually, I'm not gonna say that you have to go through Scalpers Market, but going through those three segments specifically will introduce you into what I've now introduced to new students. Yes, we would open up trading during class, executing during class, analyzing the potentials of whatever, and going in, and that's conditioning, and it's just around 8-10 weeks around there of that. Donzi Trades, I signed up for the second mentorships. Will they run simultaneously? No. They well, different days in the week. Yes. And I'm 2 days a week, right? And they're going to be an hour long, 30 minutes Q&A. And the second lecture of the week is kind of a rhyme of the first one, but with added content. It really is like that because I have international students. I have students coming from, Austria, from the UAE. I have students from Australia. I have students from everywhere, right? So I have to make sure to separate and really strategically put a good a time span within the 2 days a week that we do these lectures. So, for example, the beginners one typically tends to be on Thursdays and Saturdays, I believe. Thursdays, 6:30 p.m. Pacific, and I think Saturdays roughly 10 a.m. 10 or 10:30 a.m. or something like that, Pacific time, right? Just to give you an example. You're in Italy. Okay, that's great, right? That's exactly what I mean. Thank you for signing up, by the way. Crush 616 saying, sup? What is up, man? And Joe Hutton saying, nice content. Thank you, buddy. Really, really appreciate you. I didn't really notice if you guys were still here, but all good. Little Nikki saying, with that, with what you know now, would you have done anything different from when you first started trading? That is a good question. Yeah, I would not have put any money down. Oh my goodness. You know what I mean? Oh man. And I did a lot of learning too, guys, but also I don't know. Actually, no, I don't think I would change anything, guys. I'm going to be honest with you. I don't think I would change anything because it was that lesson that ended up teaching me more and more and more. It is kind of a high tuition. You got it. You got it, Joe. Got you, buddy. So, I don't think I would change the trajectory. Guys, remember, I became ARCa without really trying to be ARCa at 6 months from my first ever. AMC taught me too. So yeah, it was kind of, I was already giving analysis with higher probability plays based on mathematical solutions, statistical against some physics and stuff at 6 months. That's when I decided to turn to start I wanted people to think that I was a nerd or something, so I just put ARCa Bulls because that is it's the plumbing of the markets, and also Eric Crown from Crown's Crypto Cave, He was a licensed market maker and trader at the top floor of the NYSE, and that top floor is called or named ARCa. So because I learned such a great deal from him in specifically volatility and statistics, I, it silently in a tribute to him, I named myself ARCa. But it's also kind of a, it's also kind of a nerdy thing because, it's a clearinghouse, just like the IEX, just like the I think the CBOE, right? You have NYSE, you have all kinds when you are, when there's the market routing, the order routing. So yeah. And now Lil Nicky's saying the struggles build. Yeah, the struggle builds you. You're saying, yeah. You know what? I would have to agree with those teachers being the best teachers. Yes. Oh man. And yeah, I think that's why I probably won't change anything. I think that it was crucial for the lesson to be. I'm not any way perfect, guys. I will screw myself here and there, and that sucks. I'm not perfect. So it's just, it's how we can move on from it and how we deal with it, So a bulldozer saying, I feel like controlling the emotions behind a loss can either make or break you, sometimes both. Well, understanding the statistics behind that as well is something pretty, I ignore it a lot, and maybe we shouldn't. The probabilities of losing a trade after a losing trade are in the 80s of percent. What do I think about the future of silver? I think the future of silver is in a super cycle alongside the markets, because if the markets continue to appreciate, if they continue to not have a reason to capitulate, then the anxiety would also grow alongside or parallel to risk on assets. And I say that because typically speaking, silver, gold runs inverse the market historically. That drives a hedge against potential risk on assets should the markets turn around. You're buying silver and gold at the bottom when markets are topping. But in this case, we are running a very, very unique situation. Metals running alongside equity and all that. And man, that introduces to you anxiety up the yin and yang, right? So yeah, as long as the markets are running, then I can actually see silver and gold continue to run. And when the markets capitulate, I'm not sure that gold or silver may capitulate, or maybe a bit, right? But I think they'll probably continue on their run of opposition, which is really interesting. I haven't seen anything like this before, so we'd have to go back in time and really test this. They're putting a lot of money in the markets. Yeah, they are. I mean, yes. I mean, fact. It is almost grotesque. But yeah, also, yeah, Guardian, you're right. Be curious to look at oil too, right? Oil, nat gas, bonds, your 10-year yield, all those things would run inverse the market. They typically give you the ideas of potential resistances and or supports. Your DXY, right? Your dollar value would, in a macro sense, run against the markets. And what I remember being a direct opposition was actually gold against Bitcoin, or the DXY against Bitcoin even still, right? So that's not really the thing now. Or I have to test it, right? I still have to test the DXY and see how that's behaving. But I mean, all good. And these are all really good questions. The Venezuela thing, yeah, that's right. Didn't they mention the Venezuela thing while Friday was going? And then the markets kind of corrected on that, starting in the AM. Yeah, they did, right? Man. I hope that didn't already get priced in, and then out of nowhere, boom. I don't know. But yeah, team, more to test, right? More to test. We still have a market prep later on tonight. And so, I'm still going to release another XRP video tonight too. So it'll still be okay. All right, guys, but keep them coming. Any questions you guys have, team, no matter what it is, I'm here to answer them for you. We're goody. We're all the way goody. In fact, I got to turn on the air a little bit, man, because wow. It's turning into something in here. It seemed like someone knew something before everyone else on that Venezuela thing. Man, isn't that the truth of it all on the always side of things, right? I hate that, man. I truly do hate that. But you know, it's part of the dynamic, and just in the moment where you get you get caught with your pants down, and you're like, you think 2026 is going to be crazy for a crazy good year? You know, that's what I keep hearing. And also, I keep hearing too that there's going to be the biggest recession and biggest. I mean, but that's what everyone. I almost, you know what, guys? I'm going to be honest with you. Like when you're catching the upsides on markets, the biggest type of influence and the biggest drawing of attention is either you're saying we're going to freaking $800, or you're saying that the market is about to crap. Those are the biggest ones. So if you're kind of like me, to where I'm just expressing a very non-biased opinion and giving you what the truth could be based on what I am observing, then that doesn't really drive that much of attention. But I don't care. I'm not here for that. I'm here because the chart is the chart, and I'm not going to put narrative, and I'm not going to put some way to get more subscribers or more likes in light of giving you some false information. I can't do that. I couldn't even live with myself if I did. That would defy everything that I study. That would defy me as a systematic trader. You know, that how could I come back from that? You know, that would be absolutely horrifying. You know, and then to be wrong, dude. I'd rather be wrong on something that I really studied, you know, than to be wrong on something that's just a huge false hope. You know, my goodness. So, old man saying one has to remember it's all about the clicks and likes from the majority of the influencers. Yeah, so extremes ideas sell. They definitely do, right? They absolutely do. So what I could do is just observe the charts here, right? And just like I have before, right? And tell you that by 2035, we should be seeing a $350,000 to $500,000 Bitcoin. There is the potential of a million run, should it be that we have another cycle introduced. But, you know, that's going to be one video. And then what's next? Yeah, but, you know, to each their own. I think there's a good balance of people speaking probabilities and people speaking strategies and stuff. I think I'd like to stay within the more medium-term things. You know, we can observe things that can happen into the next couple months, maybe weeks, into the next weeks, maybe couple months, right? And then really observe the day-to-day price, the forecast. I was already hired, guys. I was already hired by publicly traded companies to give them macro outlooks, to give them immediate short-term outlooks. This was 2 years ago. So we can do it all. It's all good. So it's really no problem on my end, team. And should you need that information, say, ARCa, we need to look into the future. 6.5 years from now, where will this be? I don't know where it will be, but we can observe the probability of it, right? But yeah, team. So if that is it for the questions today, team, I want to go ahead and encourage for you to enjoy the rest of your weekend. And let's gather up tonight, right? Just a few hours. That's going to be roughly what? I'm going to try to get it started, team. I want to try to get it started. I can't promise this because I still have my son here, right? Then he has school tomorrow. So it's either going to be 8:30 p.m. Pacific time in the Discord for the market prep and the filming of the XRP video. Or let's see if we can try like a 7:30, something like that, p.m. Pacific, right? But no, guys, thank you all so much. Thank you, YouTube, for watching, for observing. I hope to see you. I hope to see you in the lectures, team. So take advantage of that, guys. I promise you that that 2 lectures, 2 algorithm thing, guys, that's not even the price of one. So man, with algorithms, yeah, you choose. You go ahead and you choose. But yeah, it's not even, man. It is really a blowout, okay, team? I love you all so much. You take advantage of it as much as you can. And then, we'll see about it happening again in the year. You got it, Loretta. Thank you so much. Little Nikki, thank you, everybody. I'm going to go ahead and cut out here. No problem, Donzi. You be safe. I'll see you, Joe. Thank you, buddy. See you, Jay. ARCa does a class. I see Jay in there. Yeah. Lioness, take care. Take care. That's my little guy saying goodbye. All right, team. Take care, everybody. I'm just going to go ahead and do an outro on this. And I will personally say goodbye to the team right after it. Okay, team? I love you guys. I love you. I love you. I love you. And I love you. Please take whatever I do show and iterate within these videos as just a form of entertainment, as I cannot suggest for you to buy, sell, or hold any assets whatsoever. Ever, 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 ever. I need you to do your own due diligence and everything will be cool. But with that said, team, I wish you well. A very good rest of your night and or day, and I'll catch you at the Bell Mañana. Adios, team. Oh, yeah.